In today's episode of the Daily Brief, I'll talk about two interesting stories. I first talk about the big moves RBI made recently, and in the second one, I talk about what's happening in the microfinance space. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's much more deeper and contextual compared to the news channels. I'm your host Krishna. Today is Friday, 3rd of October. The RBI just concluded its latest monetary policy meeting. And while the monetary policy can be dry, what Governor Sanjay Malhotra announced on Wednesday is pretty fascinating, both for what they're planning to do and for what they didn't do. There are three big themes we want to discuss. First, we ask why did the RBI hit pause on rate cuts, despite inflation cooling off significantly. Second, we'll look at where India's economy is actually headed, because the story has developed some interesting twists. Finally, we are diving into a massive package of banking reforms that could reshape how India's credit flows. Let's dive in. At its latest meeting, all 6 members of the RBI's Monetary Policy Committee voted unanimously to keep rates unchanged. The repo rate stays at 5.5% and its stance remains neutral. On the surface, this might seem like a non-event, but there are things to unpack here. What makes this interesting is that India's inflation has cratered. We have seen a massive drop. Back in June, the RBI projected 3.7% inflation for this financial year. 2 months later, by August, they revised it down to 3.1%. Now they are calling it at just 2.6%. That's a drop of more than 1% in just 4 months. For the second and third quarters this year, they are projecting inflation at just 1.8%. That's actually below the RBI's tolerance band of around 4%. Food prices, in fact, have actually gone into deflation, coming in at negative 0.8% in July. This was concentrated in a few items. Vegetables, for instance, were down 15.9%. Pulses were down 14.5%. Even core inflation, the steady, non-volatile part of inflation basket, sits at benign 4.2%. If inflation's down, that opens room to push more money out into the economy. If inflation falls too fast, it could even be a sign that a cut is necessary, that prices are falling because nobody is purchasing anything. But that's not what the governor went for. At least for now, rates will stay where they are. But why the pause? The governor laid out 3 connected reasons. First, they want to see how previous rate cuts are making their way through the economy. They've already cut rates by 100 basis points since February. Just mechanically, that should bring interest rates down by 71 basis points. But in reality, banks have only reduced the interest on fresh loans by 58 basis points. The transmission, it seems, is still playing out. Second, GST rates were only just rationalized. That's going to bring prices down while stimulating consumption at the same time. Precisely what the RBI is targeting itself. Third, there's too much uncertainty around the global economy. Tariffs, trade wars, immigration chokeholds, and more. If our exports fall, hurting our economy severely, the RBI wants to have room to maneuver. Now that doesn't mean rate cuts are out. All RBI governors speak cryptically, so you have to read what they say very carefully. But in previous statements, the RBI talked about having limited space to support growth. This time around, however, the word limited is gone. They mentioned that falling inflation opens up space for supporting growth. The governor has signaled very quietly that they might cut rates soon, just not yet. When asked why he dropped the word limited, Governor Malhotra was direct. Growth inflation dynamics have shifted enough to open up policy space. Inflation has fallen considerably while our trade problems have hurt our growth prospects. Now that said, he did emphasize that there are developments and events every week, every day. Don't take those cuts for granted either. Now behind this decision is a paradox the RBI is dealing with. India's growth is strong but not strong enough. Our first quarter growth came in at 7.8%, well above expectations. The RBI actually revised their full year growth projection upward from 6.5% to 6.8%. At first look, we are doing really well, but things might not remain upbeat for long. The growth behind those improving projections, it seems, was all in the first half of this year. Over the second half, in fact, the RBI has actually lowered its projections. Q3 growth is now projected at 6.4%, Q4 at 6.2%. But why the gloom? Tariffs. As the RBI governor himself said, trade-related headwinds will weigh on growth in the second half of the year and beyond. Domestically, in fact, things look quite upbeat. We just had a good monsoon. Our reservoir levels are healthy. Our services sector is strong. Employment has been steady. Agriculture looks solid. Rural demand should pick up. GST cuts will help consumption. There's a lot of good news. But we face serious pressure from outside. Our export-oriented sectors, gems and jewelry, shrimp, textiles, pharma, these will all feel the blowback of trade disruptions. As the governor mentioned, while India's economy may primarily be driven by domestic demand, one can't ignore external headwinds. Now India is trying to find a way out of this quagmire. We are working hard to diversify our export markets. The government is already negotiating trade deals with other developed economies. It just signed one with the UK and talks are ongoing with Oman and EU. Our fundamentals too look strong. Our current account deficit is in good shape. From 0.9% a year ago in Q1, it fell to just 0.2% of the GDP. Our services exports are robust, with software and business services growing strongly. Remittances remain healthy. Forex reserves are at $700.2 billion, enough to cover 11 months of imports if everything else collapses. But for all this, the rupee still looks concerning. As the governor delicately put it, it is witnessing some depreciation accompanied by phases of volatility. For now, they are not targeting any specific price, but he has signaled that they'll watch closely and will intervene to manage undue volatility. Inflation, meanwhile, is slated to tick back up. The RBI projects Q4 inflation at 4% and Q1 next year at 4.5%. Our current run of good luck, it seems, will soon end. But the bottom line is this: while India's growth story remains solid, it's moderating. It's below our aspirations in the governor's word. While low inflation may have given the RBI room to maneuver, the question is about timing. When do they make their next move? But while the RBI may not have changed its rate, it announced a flurry of regulatory reforms, 22 separate measures that could fundamentally change how banking works in India. These could frankly be a bigger deal than the rate cut itself. Let me walk you through the biggest ones. First, risk-based deposit insurance. Right now, every bank in India pays a flat rate for deposit insurance, 12 paise per 100 rupees of deposits, regardless of whether you are a super safe bank or a risky one. That's been in the system since 1962. Starting next financial year though, the RBI is introducing risk-based pricing. Better rated banks with sound risk management will pay lower premiums. Riskier banks will pay more. This creates a direct financial incentive for banks to manage their risks better. Run your bank well and you'll save significantly on insurance costs. Cut corners though and it'll hit your bottom line. This could really shift behavior in the banking sector. And it aligns India with international best practices. Most developed countries already do this. Second, capital market lending changes. The RBI is opening up capital market lending in a big way. For one, they're creating a framework for banks to finance corporate acquisitions. Indian banks will now be able to finance Indian corporates buying other companies, something that was largely off limits. This could be a game changer for M&A activity in the country. They're also hiking limits on lending against shares from 20 lakhs to 1 crore per person. IPO financing limits meanwhile are going up from 10 lakhs to 25 lakhs. These limits hadn't been revised since 1998, and once you consider inflation, they had practically gone down each year. This move opens up much more credit for market participation. Here's the biggest one though. They're completely removing the regulatory ceiling on lending against listed debt securities. No cap. This could hypercharge liquidity in the corporate bond market. 3. Removing restrictions on lending to large borrowers. From 2016, after the NPA crisis, the RBI introduced a framework that progressively restricted lending to large borrowers. By 2019, if you were a borrower with credit limits of let's say 10,000 crores or more from the entire banking system, there would be restrictions on how much banks could lend to you. The idea was to reduce concentration risk, pushing big corporates to diversify funding through bonds and other sources. That's now being scrapped. The RBI thinks it already handles concentration risk at the individual bank level through its large exposure framework. If they need to manage system-wide concentration risk, they can use macroprudential tools or system-wide measures that don't penalize any one borrower. A blanket restriction doesn't make sense. Fourth, infrastructure financing by NBFCs. The RBI is proposing to reduce risk weights for NBFCs that lend to operational, high-quality infrastructure projects. It will release draft regulations on this shortly. Lower risk weights means lower capital requirements, making it cheaper to lend, sending more credit flowing to infrastructure. Crucially, this applies to infra projects that are already operational. They're actually up and running. Naturally, they are much less risky than projects under construction. The RBI is just aligning the capital requirements with that risk profile. Given India's massive infra needs, this could channel more NBFC funding into roads, ports, and power projects. Fifth, internationalizing the rupee. The RBI announced 3 measures to internationalize the rupee, which together are perhaps the most far-reaching part of RBI's package. First, they are letting Indian banks lend in rupees to non-residents from Bhutan, Nepal, and Sri Lanka for cross-border trade. Second, they are establishing reference rates for currencies of India's major trading partners, starting with Indonesian rupiah and UAE's dirham, to facilitate direct rupee-based transactions that don't have to go through the dollar. Third, they are expanding what you can do with special rupee Vostro accounts, or the rupee accounts that foreign banks hold with Indian banks for trade settlements. Previously, that money could only be used to invest in government securities. Now, they can invest in corporate bonds and commercial papers too. Now, these are interesting. Every time people from two countries use a third country's currency for trade, like the dollar, they add cost and complexity. If Indian exporters and importers can settle directly in rupees or in the other country's currency, it's more efficient. It reduces transaction cost, and over time it could reduce dependence on the dollar for regional trade. Now, setting these new reference rates in particular cracks a key chicken and egg problem. You need reference rates to encourage direct trading, but you need direct trading to have good reference rates. As Deputy Governor Swaminathan noted, there aren't many active transactions to begin with, so the RBI has to show the reference first and the market has to pick up from there. They're essentially going to seed the market and see how it develops. Now, this is a long-term play. The rupee isn't going to challenge the dollar anytime soon. But it doesn't have to. This could gradually make the rupee more relevant as a trade settlement currency for regional trade with South Asia, Southeast Asia, and the Middle East. And that could kickstart its relevance. Now, here's the RBI's recent meeting in a nutshell. On rates, they are in a wait and watch mode. But they have signaled that cuts are coming. They are just being patient about timing. On the economy, the RBI sees growth as solid but moderating. Our domestic strength clashes against several external headwinds. This is what the RBI is trying to navigate, but happily, inflation has given them room to move. The most interesting developments, however, have come on the regulatory front, marking a fundamental shift. After years of caution following the NPA crisis, the RBI is now loosening deliberately to get more credit flowing to productive parts of the economy. These are ambitious bets on the maturity of our banking system, and it reflects confidence in India's economic trajectory despite the global chaos. The story of microfinance in India has a pattern of running too hot and then too cold. After the pandemic, microfinance lenders went on a lending spree as money was cheap and demand was high. However, maybe it was too cheap, as borrowers racked up multiple loans, even from 5 to 6 lenders all at once. By late 2023, repayment troubles began bubbling up. We covered this earlier on the Daily Brief. What followed was a familiar down cycle. By early 2024, signs of stress were everywhere. Microloan growth, which had been roaring, suddenly hit the brakes. In fact, the industry's gross loan portfolio shrank from 4.3 lakh crore in March 2024 to around 3.5 lakh crore by June 2025, as lenders pulled back to contain the damage. In the span of a year, microfinance went from boom to bust, a story all too familiar. By early 2025, the sector was in full cleanup mode, with lenders putting a full stop to their hosepipes. The encouraging news is that this down cycle may seem to have an end in sight. By mid-2025, most players had recognized the mistakes and implemented new safeguards. The Microfinance Institutions Network, the representative organization, even introduced new guardrails to prevent overborrowing. This proactive approach means that although the down cycle has hit hard, it hopefully won't last as long as the previous one. So we decided to see how much this holds true by looking at the industry data and management commentary. So let's dive in. See, the past year has been nothing short of rough, but there are hints that we are nearing the bottom. After years of double-digit growth that peaked at around 20 to 25%, microfinance loan books actually shrunk for several quarters. The total outstanding microfinance loans fell to around 17% year-on-year by June 2025. Basically, instead of chasing growth, companies switched to survival mode and shrinking their business if need be. Naturally, with less lending, the borrower base also shrank notably. The industry lost around 2.4 crore borrowers in a year, likely either those who defaulted or opted out of the borrowing further. Interestingly though, the average loan ticket size went up. This could mean lenders focused on slightly larger, presumably safer loans to fewer, more credit-worthy customers. Fewer people are borrowing, but those who do are taking somewhat larger loans on average. But the most important thing to look at is defaults. By August 2025, almost 13% of the microfinance loan book was in serious trouble. These are loans that haven't been repaid for more than 90 days. That's a huge number and shows just how much stress had built up. However, this figure is a lagging indicator. It captures only the old loans that had already gone bad. The leading indicators like loans overdue for less than 90 days are actually improving. In other words, people who borrowed recently are defaulting less and less. That's a positive sign of stabilization. This also makes logical sense. Lenders had slowed down the issue of new loans, which allowed the older problematic loans to gradually get cleaned up. At the same time, because lenders became more careful, the new, more creditworthy loans are naturally not defaulting as highly. There are other signs that the market is finally bottoming out. For instance, collections from already defaulted accounts have also jumped significantly due to recovery drives and even some legal action by the MFIs. Recovering money from loans that were basically written off as lost is just icing on the cake, as it directly adds to profitability. Now let's take a look at what the actual players on ground, the management of banks and MFIs, are saying. In their recent commentary and interviews, an interesting theme has emerged: cautious optimism. Different companies have different experiences, but almost everyone's commentary acknowledges the stress and points to light at the end of the tunnel. The CEO of Kotak Mahindra Bank, Ashok Vaswani, was quite upfront about calling the peak.
MFI credit costs were a significant contributor to the overall credit cost increase. However, it appears to have peaked and is expected to show a declining trend in the coming quarters. We have started cautiously stepping back into fresh disbursements given the declining trend in incremental slippages.
Meanwhile, C.S. Shetty, the chairman of the biggest bank of the country, SBI, pointed towards improved asset quality.
I think we never had any issues in our unsecured book, as well as our MFI exposure is minuscule. But we believe that from a system point of view, there is definitely an improvement in the asset quality in the unsecured loan and MFI segment, while lot of upfronting in terms of cleaning up the book by MFIs is also one of the reasons why we believe that situation is better now.
Now, Kotak and SBI are some of India's biggest banks, so it's worth remembering that only a small portion of their business comes from the MFI segment. On the other hand, a few NBFCs whose bread and butter is lending to MFIs have much more higher stakes and are hence closer to the ground reality. Take Arman Financial Services for instance, which is a small NBFC that runs microfinance through a subsidiary, as well as some two-wheeler and MSME loans. Their CFO, Vivek Modi, gave a candid reply when being asked whether the credit cost peaked out, saying it's nowhere as simple as a yes or no.
I think I wish there was an answer which could be done as a yes or a no, but then that's not the case. I think the industry is still going through a bit of pain. Things have started to improve in the last at least 2 quarters in terms of the early indicators being in terms of the improvement in the zero bucket or the current bucket collection efficiencies. But the entire process needs to trickle down to the lower buckets as well and also accelerate to that extent for the entire sector.
Yeah. The joint MD of Arman, Alok Patel, echoed the ambiguity of his colleague.
I was saying that there were good indicators in March and then I turned out to be wrong. So ask me next quarter, I promise I'll give a better answer.
However, another MFI-focused NBFC called Spandana Spurti gave some precise timelines on how the business might recover.
I think one more quarter is what we believe there will be a pain. If you look at our lending and this will hold true for most of the microfinance entities. The weighted average maturity of the loans will hover around. For Spandana, it is at presently at 6.7 because the disbursements have been low. But on a normalized basis, also it is never beyond 9.5, 10 months. So technically speaking, any pain or any churn of the book should not take more than 4 quarters, and I think we are already down 3 quarters in the pain. So that way, for the churn to happen, it should not take more than a quarter from here, is my understanding. And in terms of profitability, yes, like I said, one more quarter is what we see as pain, but thereafter we should see better numbers for Spandana.
Now coming back, clearly across the board, the tone has shifted from panic to pragmatism to guarded optimism. Different players may differ in how optimistic they are. Where a big bank might be more cautious, a pure play MFI might be more excited. But none are preaching doom and gloom anymore. Betting on the timeline for this recovery though would be tricky, and that's clearly visible in some of these answers. Going by the most bullish estimates, by Q2 FY26, results should start coming soon. The worst case scenario talks about waiting for FY26 to wrap up. Either way though, the direction of recovery is something everyone agrees on. All the optimism from companies and analysts rests on one big assumption, that the end borrower, mostly low-income rural households, will be in a stronger position to repay loans going forward. So this raises the question, how's the health of India's rural economy and consumers? The short answer is that it's not quite healthy. In fact, we did a story on this not too long ago. Rural consumption has ticked up, but not because rural incomes have increased, but rather due to disinflation. And that distinction matters a lot for MFIs. As the story goes, FMCG volumes have outpaced urban for several quarters, and a good monsoon helped improve farmer sentiment. However, rural wages have hardly climbed because even if more crops were grown, crop realization stayed muted. In some regions, excess rain and floods actually dented output. In fact, the savings rate of households have fallen, while consumption is taking up a much bigger part of their income. That's not really prosperity, but survival that's made possible only while inflation is soft. And as we mentioned in our story earlier, this disinflation is extremely fickle. But there's one more ticking time bomb. Gold loans are booming. Households usually pledge gold when cash is tight and need quick credit, so they are willing to sell off whatever long-term assets they have. Now this is not at all an optimistic sign. The microfinance sector does seem to be emerging from its stress cycle. The banking data suggests it, and so do the CXOs of the biggest lenders in the space. They might not agree on the exact timeline, but they agree that the recovery is underway. But there are still good reasons to be cautious. The rural economy may not yet be structurally strong enough to support this recovery. So, what should we watch? It's not enough to just track the non-performing asset figures at these lenders. We also need to keep an eye on data that reflects the health of the rural economy. Think rural wage inflation, agri output, tractor sales, Manrega demand, any proxy that helps answer the fundamental question. Are the people who borrow in the MFI segment truly in a position to borrow again and, more importantly, repay? Until we have stronger evidence on that front, the upbeat commentary from management and even the improving banking data don't paint the full picture. Now, coming to Tidbits. The government has extended its flagship export incentive scheme until March 2026. The program refunds exporters for taxes and duties not covered elsewhere, helping offset costs and keep shipments competitive, especially after recent US tariff hikes on Indian goods. Japan's MUFG is in advanced talks to buy a 20% stake in Shriram Finance for about 23,000 crores, which would be the largest FDI in India's NBFC sector. India's manufacturing growth slowed in September to a 4-month low, with the PMI easing to 57.7 from 59.3 as new orders and output weakened. At the same time, factory prices jumped at the fastest pace in nearly 12 years due to rising input costs, even as optimism rose on the GST cuts and stronger demand outlook. US tariffs remain a key drag, though export demand outside the US showed resilience. That's all the news that I have for you today. See you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.